identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, hello folks, let's go. So where are we? The most exciting thing going on now is oil coming down very nicely. And now we want to put a stop because if we be super greedy here, we're up $7,000. So setting a stop is easy. All you have to do is offer to buy it back at $73.50. So that's a buy one stop, and I can set my second stop up a little higher at $73.60. So hopefully I don't both get triggered at once. And then what you do is basically once you decide to set your stops, you very simply then you can just drag them down. In fact, watch this. If you have Thinkorswim, this is Thinkorswim. If you have Thinkorswim, you can just take your stop and go like this. So as it trades lower, you just lower your stops to follow it down. It's very simple. All right, so then I'm going to stop out on my last two contracts. We had at some point there, I went in and out a couple of times, but basically we've been following it down. See, earlier when we got to 73.50 before the announcement, or close to 73.50, I think, like, or what was it, 74.70? I don't remember. Before the announcement, we were somewhere down here, I think, 74, like 74 or 5 or whatever the hell it was. And we took off the short. I forgot what what were we doing in chat? I forgot now. It was so long ago, wasn't it? So actually, to recap the trade, which is the same trade we've been making for like 2 weeks, so it's nothing special here. It's like we decided that this was a good topping place for oil to trade, and so once again this morning. Oh, I didn't do it here. No. We were busy talking about this nonsense. Okay. Oh no, I did say it here. I did. Okay. So I said, here you go, blah, blah, blah. Speaking of taking it away, we still like to play oil below the 75 line with type stops above. Yesterday's API report showed just a 4 million barrel draw in crude, but it was wiped out by a 3.7 million build in distillates, and I forgot to highlight the API report. Gasoline broke the tie with a 1.5 billion barrel draw, but that's not likely enough to hold 75 if the EIA report also indicates the holiday drawdowns are fading fast, which has been our premise. So it's not like nothing surprising here. This is what we expected to happen. And then we got off track of that. So then obviously once the chat starts, we get a little more specifically into it. And the first thing I said today, comment omitted. What the hell? You are kidding me. My first comment didn't publish? Oh, that's so messed up. I had no idea. I swear that published. Hang on, I'm over my other computer now. I gotta see what's in there. What time is that? 10:37. Wow, I did not even know that it didn't come out. Oh, that's crazy. Oh man, I had a whole conversation. I am so sorry. I had a whole conversation about the oil report, and then I was waiting because ahead of the oil report, I started typing a whole bunch of shit with charts and graphs. I had no idea it didn't come out, and I didn't think about it because I didn't think I put anything complicated in there. What? I don't know. It's lost now. I mean, I don't know what it must have put in some kind of chart that it didn't like. And so usually what does this is like too much data in the chart or something. Oh, I'm so pissed off. Anyway, so at that point, I was reiterating my short. For some reason, the EIA was delayed. And we talked about that a little bit later too. Now, Tommy said, but yeah, I investigated and found out that they were going to have an hour late EIA report, and I said that can't be good. And you know, it's probably, and then Tommy said the same thing. Tommy said that's so they can unwind their positions. And I thought he was just agreeing with me, but he wasn't just he wasn't just agreeing with me. He was he had his own thought. It was his own thought on the subject. I had already said that, and then he said it, but I thought he was just saying what I said. But the release was delayed, and he said the new report will be out at 11:30, blah, blah, blah. So anyway, bottom line is the release came out. Now, I said at 11:03, still before the report, given 4 shorts at 75, I think below 74.50, that has to become a stop for 2, and then 2 again at 75 to lock it in. That's what we were talking about. So we had the shorts at 75 when it crossed below. Then it went below 74.50, and I said that should be a stop line once it goes below it. It never came back up. We had a nice ride to 74 before we got bouncy, so that's where that's where my first 2 got stopped out. And but then it went below 74, and I went back in again. So really, there's no harm, no foul on the stopping out. And now we're down to 73.05. Oh, remember what I said about bringing the stops down? So we just keep bringing the stops lower to follow it, because at this point, you know it's going to be bouncy. In fact, what is the 5% rule telling us? Okay, 75. This is important too. For even see, the 5% rule does work for day trading. You just have to stay within your periods. And if you don't see a good consolidation zone, don't play it. But clearly, the 75 line was a good consolidation spot for the day. Remember, it goes by the period you're trading in. So 75 was good for the day. And so you take 75 times 0.975, that's 2.5% lower, is 73.12. Look at this, see the magic? 73.12. So this is the 2.5% line from 75. So now we know that 75 minus 73.12 is 1.88 times 0.2 is 37.6 or 38. So we know now for sure that the bounce line is 73.12 plus 37. That's your weak bounce. So that means 73.50 is the weak bounce line. So it's almost pointless not to take the money off the table here, because it's almost certainly going to bounce to 73.50. The 2.5% line is also a major point of resistance on the pivot point chart. That's too much coincidence for us to ignore. So it's silly not to get paid at 73. So we're going to set a sale at 73, and we're going to buy one at 73. So we're going to get at least one off the table now. We only have 2 left. We're going to get at least one off the table at 73. And as soon as that triggers, if either stop triggers, remember we now have 3 sales here. If either stop triggers, we're going to take one of the other ones off. Okay, so but well, obviously, if this one triggers, we're going to take that off because that's pointless. If this one triggers first, we'll probably take this off or drastically lower that stop to another level. And that's how we're going to play that. So basically, why? Because the chance of this line not being bouncy is virtually nil. And that means that it makes no sense for us to why should we play for the bounce? The bounce is 50 freaking cents. We were already told that. Now 73.12, remember, was the bottom, was the 2.5% line. But when you see something falling this fast, it's not like the 2.5% line is likely to hold. So, but even if it does hold, the bounce line is 73.50, and the next bounce line above that is 38 cents. 38 cents above that. So So basically, it's 73.50, and then 73.80, 73.88 basically would be the next bounce line. So, but essentially it's 73.50 and 74, just like normal is where you expect things to go. And that's how you figure it out. So intraday, you can use the 5% rule to tell you what to do as well. All right. And again, like I said, now these should be like, they should be at 25 basically at this point. Whoop, no, as it races up to catch me. So that first stop should be at 25, and we can bring this one down to like 35. And you see what's happening every time we do this, it's another $500. Every time we move this 10 cents down, that's $500. Or $50, sorry, $50 for 10 cents. $5 a point, right? Up. So who triggered? Not these guys, who triggered the one that you thought wasn't going to get hit. So now I'm down to one short because the 73, even though this elevator isn't very close to 73, it's still spiked down there and triggered. So I'm going to leave that one at 25, and I don't want to end up being long, so I'm going to take this off, and that's my last contract. So we're down to one contract. If it go, and we're back in the same position we were 20, 30 cents ago when I first set these stops, except now I just triggered a stop that was all the way down to 23. So we made 50 times $5 is $250 just because I followed a proper protocol to stop out of the position. All right, so now we got one left. I don't even care about the one left. In fact, I do care, but we just blew past my stop. Shouldn't have. It should have triggered. It went by so quickly it didn't trigger it. That's not good. I'm going to move that back to 50. Still says I have one left. I'm going to give it a little bit of room to run. Because if we're below the 73 line, we'll see what happens. Because it could be a 5% drop. But you got to take something off the table when you have a run like this. And don't forget, I didn't start off wanting 6 contracts short. I started off with 2, and then it worked into 4, and then I went back to 2, and then I went back to 4. It's not like I wanted to have 6 short contracts and make $50,000. That wasn't because again, you're risking $50,000 when you do it, so you don't want to take a loss like that. So we just let it play out and see how it goes. Oh, look at that. It's all the way down to 72.50 now. Son of a bitch. That's crazy. Wow, look at that. So I guess we'll lower it again. And there's no harm to doing this. That's what's fun about working this thing. Just move that elevator. You move this wherever you want, whenever you feel like it. All right, so now we'll leave it alone, and hopefully we'll either stop out or we'll get some crazy level. Well, in fact, here you go. 72.50, Jesus. Seriously? Wow, it looks like it's going to hit that. Okay, so we'll take the stop at 72.50 if it's going to give it to us, and we'll be gone. That's just crazy. And if it keeps going, you say, oh, well, no, that's not lasting. Somebody came in and bought a bunch. Whoa, somebody came in and sold a bunch. Very exciting. Oop, that's it. Look, 72.50 triggered. So now we're done. So because I did that properly, when we started shorting, it wasn't very long ago, right? We started shorting at 73, and we started to stop out at 73.50. I didn't stop out at 73.50. We actually took our first stop out around 73, and now we stopped out our second stop out at 72.50. So that's an extra $1,000 in the time we've been discussing it. 1,000 plus not 1,000. 500 plus 250. Another extra $750 in the time we've been discussing it, simply by following that protocol. That's where it's very useful for you. If you're going to trade the futures, that's the way to do it. You want to make sure you let those, it's what they call trailing stops. And there is, by the way, a function in Thinkorswim for setting trailing stops, but it's bullshit because, as you saw, the thing blew past my stop and didn't even trigger it. Because the problem with any stops is that if it doesn't actually hit your line and it goes past it, the stop may fail to trigger because it didn't actually hit the number that you're at. And then nothing happens and you're still stuck with your position. So you got to pay attention to it. You can't really walk away from these things. You know, as a rule of thumb, if you have to go to the bathroom, you shouldn't be playing the futures. That's pretty much the way to look at it. Holy crap, look at this thing. That is so cool. I'm gonna take a picture of that for tomorrow. That's what I do, just go beep. All right, so on to other things. I still have my NASDAQ shorts. Here's NASDAQ. Those are up. Oh, no, we stopped out of those. Huh? I forgot. Okay, yeah, we had a stop set over here on same thing. Went down here, set the stop here. That quickly triggered. Didn't want to get back. I didn't want to get back into it. I want to short at 1,500. You got to be 15,000. You got to be patient. But these made 2,800 bucks on that little tip this morning. You know, and that's what's fun about the futures. But you got to be patient and play it from the right place. You can't just randomly pick places. You have to wait for it to get to your spot and then short it. And of course, under the conditions which you think are correct for making it work. So what else do we have going on? All right, so we talked about that. When the inventory did come out, I said not quite as disappointing as the API, but it wasn't enough to save the oil either. And here we have, we were down 7.4 million, but that's balanced out by 3.7, so down about 4 million barrels total. Then a build in gasoline is only down 3 million. That's basically where API was. Net $3 million draw, 3 million barrel draw. And we talked about the OPEC thing. And you know, it's funny because I get a lot of people who actually say, you know, oh, you do too much news on your site. You should talk more about stocks. I'm like, that makes no sense. The reason we're so good at picking stocks is because we pay attention to the news, and in that constant reading, you sometimes figure something out. You know, and I did change and that's, by the way, I did make that change consciously a few years ago because I realized like so many people on the site were just there to like follow trades, and nobody wanted to do the work and nobody wanted to learn anything. And it was just people who were like, what's the next trade? Where's the trade? What am I trading? What should I do? And I don't like it. It's work. Trading is work. And the work, and my kind of work, the way I work it, is reading. There are guys who say the work is drawing charts constantly and doing that. I think those guys are idiots, but that's beside the point. For me, fundamental investing is what it's all about. And what I care about is thinking strategically about the markets, but the markets have to be placed into a context of the entire geopolitical situation. And then people say, oh, you talk too much about politics. I'm like, do you not think politics involves the markets? Is politics not something critical to the way the market's going to react to things? It's like, of course I'm going to be analyzing politics. Of course, okay, fine, I'm a liberal bastard, I know that, but that's me. I'm honest about it. And that's another thing. Conservative guys on the site are like, they're like, you shouldn't be so liberal. You should be neutral like everyone else. I'm like, okay, yeah, I'll lie like everybody else. That's because I lie like everybody else because I want your money. It's like, what do you think? Every single guy who writes a newsletter column has no political views? Of course they have political views. They just don't want to tell you because they're scared of losing their audience. I mean, and it's dishonest because you don't know how much it colors their thinking. That's a problem, right? If you're following a guy and you don't actually know why he thinks the way he thinks, it colors your thinking. I'm a bleeding heart liberal, so I take things from the standpoint of bleeding heart liberal. If you should take that into account. You know, just like when I watch Fox News and they say something, I will take that into account that it's coming from Fox News. And if I hear something, or if Robert Reich, who's a very good guy, we talk to him a lot. if I talk to Robert Wright and he's saying, if he's spouting off about some bullshit about the government when it's under Trump or something like that, I'm like, okay, well, Robert hates anything they're doing. It doesn't matter. He was the Secretary of Labor under Clinton. You gotta, you have to understand where people are coming from, and that includes authors, by the way, and we talk about that sometimes too. Like when you're reading an analyst report, you need to know who the analyst is and who you're reading and the authors of any article that you're reading. You got to check out the authors when they're giving you an opinion, especially if you're about to follow it. You should know who the person is. Do they know anything about what they're talking about? What do they have invested? What other stories have they had? You know how nobody wants to, people don't want to flip-flop on things. They have a certain bias and they're going to stick with it. And you got to know that stuff. And I try to be really honest, and I decided the best thing I could do was to show you guys the news I'm reading. Not all of it, but the stuff I think is important. I mean, I read 10 times more stuff than I put here, but if I see something I think is relevant and useful or funny or interesting, I'll put it here. But for every one thing I do, I must read like 10 articles that I just go, I read the first paragraph or something and be like, it's not important, or they have nothing special to say. This one's good. 24 stocks that could blow up after earnings. So that's the basis of, again, you look at this, it's in Barron's, so we take it seriously. Oh, there it goes. Yeah. Do they have a good list? Okay, but you gotta read it carefully and think about what's his premise. Why does he think that? So he's looking at Wolf Research, and they rank companies based on earnings quality, comparing sectors. I mean, Wolf is pretty good, so I don't mind that. That's a reasonable thing. But you got to read it very carefully and decide what's good and bad about it. But large stocks, no, that's not it. Where's the actual list? 10 stocks to avoid. Oh, he's only talking about bad stocks. I'm sorry, there were no good stocks in this one. I read a different article that had companies to play. So these are all companies he thinks that could have problems, and then you get interested. You say, oh, Lulu. I'm not really big on shorting though in this kind of environment. Xerox, that's a shame. See, Xerox, I'd be interested in getting into if they have bad earnings. Not Apple or Fax. Cooper, no, I'm not sure I want to go with Cooper. Lulu, T-Mobile. Oh, poor T-Mobile. But Lululemon, probably price. Oh, there you go. PE ratio 71. Don't care about them. Xerox PE 22. Like I said, I'd buy them if they got cheaper. Don't know who. Mercury, Equifax PE is 50. That's silly for them. Premier, healthcare company Premier. I don't know enough about them, but that's interesting. Cooper is cheap. That's why I don't understand why Cooper is on this list. It seems odd to me. Building products. So, all right, let's take a look at Cooper and see if we can figure out why he doesn't like them. So what is he saying? 10 companies that have experienced CFO change or recent M&A, which can generate unexpected volatility and score low on quality level relative to their peers. Okay, this is a dumb reason. And again, you have to actually read the articles. This is a dumb reason to be shorting somebody. And let's take a look at what Cooper's up to. So I haven't looked at them in ages, so it's interesting. And we'll see if we can pick up my little thingy. Cooper, oh, wait. That's not the right one. Where'd I put that? Oh no, what'd I do the article? Shit. Did I open it in a new window? Is that why I can't find it? Yes. Oh, COO, no P. So here we see Cooper. I love the fact that we can look at a stress test, which is what 2020 was now. look at its stress test, and look at how the company did. These guys still made $200 million last year. Yeah, half their earnings went bye-bye. Everybody had problems last year. You don't fault someone for that. You say, oh, they didn't lose money. Very nice, okay? Normally, 2 billion earnings, 400 million in profit. So they're running about 4% to the 4%, 40%, sorry, 40% profit to the bottom line. And here they are also still running. This is more like 20%. I'm sorry, this is 20% too, it's not 40%. This is 20% to the bottom line, 20% to the bottom line, 20% to the bottom line. It's pretty consistent, actually improving a little bit. I'm not getting heavily into like what they're doing totally, but this is a good sound company, and it's a nice niche industry. I love medical devices, and the market cap is $20 billion. So if they're a $20 billion company and they're making $600 million, and they made $500 million in 2019, this isn't a stretch, and their earnings are consistently growing by 10%, why would I not want this? So the reason that and I don't want to pick on anybody. I've gotten so many letters from people because they're like, "Why are you picking on me?" So I don't want to pick on our route, but there's tip ranks, right? Tip ranks. Whoops. Expert. Al root. Nope. ROOT. Oh, I see. ROOT. No, see, he's not even in there. He's not even a proper analyst. Oh, sorry. See, that's what I mean. I shouldn't be mean to people. He's doing his best, right? So here's our route. He's a senior writer at Barron's. Ooh. You got to look at what else he writes and see what he knows. He seems to like writing about Virgin and shit like that. Tesla doesn't have a Tesla, GM, Virgin, oil. You wonder why he knows anything about ABV. But that's biotech, so that's now thinking he might have something in the medical space. Tesla, oil, Tesla, 3M is not really biotech. Berkshire Hathaway, and then how Tesla stacks up. This dude seems to write a lot about Tesla. He's okay. He spent 17 years he was from R.W. Baird. He was the industrial strategist at R.W. Baird. So again, okay, I'm trying really hard not to say anything. I'm not going to discuss our route because I don't want to. Last time I really hurt some girls' feelings, so I'm just going to tell you I would take it with a grain of salt. Let's put it that way. His premise here is stupid, and okay, he's reporting on Chris Science premise. Okay, so that's what you want, and he's a tax policy expert. But what kind of premise is this? These companies had a CFO change. Okay, if you're any company every 10 years is going to have a CFO change. That's what happens. They have CEO changes too every 10 years for the most part. Or recent M&A. Recent M&A is not necessarily bad. It depends on the actual deal that went on. So none of this is a good reason to short Cooper. This is stupid. And Cooper is a great stock, and I'm surprised it's this cheap. So that's what I get out of reading that myself. Lulu, on the other hand, I'm sure is ridiculous, but let's stick with Cooper. Wait, let me make a note so I don't forget, though. We can add this as an actual trade. So COO, if it's priced to be volatile, it gives us an opportunity to make a trade, which is what we used to do in what we call the option opportunity portfolio. But there's no reason I don't want to own these guys at $400. So that's the only reason I don't like $400 stocks, because you can get badly burned on things like that. Whoops, see, look what happened. See, we took the non-greedy exit before it bounced back because 72.50 was clearly an overshoot of the 2.5% line. How much did it overshoot by? 0.5%. Of course, it overshot by the same amount it would have bounced. That's how the 5% rule works. That was easy, right? We could predict that a mile away. So we're all done, right? We're all clean on the options. What was I going to say? Oh, Cooper. So then I look at Cooper, and I don't like $400 stocks. Ooh, they only have short-term options. Ooh, they're thinly traded. Oh, damn it. No trade. Oh, dear. See, they got wide spreads. They're thinly traded options. Nobody gives a crap about this company, unfortunately, and they only have options out till February. So there's nothing sexy here to trade, unfortunately. It's just not worth it. So there you go, it's dead. So as interesting as that was, and as much of a good deal as this company is, there's nothing fun to trade for us. No, for me, you guys can do what you want. But because look, if you buy it for 405 and you sell the 400 calls for $30, that's okay, but not great. And then let's say you sold some puts, the puts are too cheap. You're not getting paid well for this. Or if you did a bull call spread instead, let's say we think it's underpriced here, we take the 370s for 50 and we sell the 420s for $23, $22. That's no good. That's $28 on a $50 spread. I'm having no fun here at all. So there's really not a good reason to jump into this thing, unfortunately, and that's because you've only got until February. It's a short-term contract. If you went out further, that'd be probably better, and you'd get better prices. And it's generally not a very volatile stock, so there's not a lot of premium built into it. So the only thing I've got going for it is if this guy is right, and if they go down after earnings, now in the back of my mind, I'm thinking Cooper is a good play if they get cheaper. Because I might want to pick it up if they have a nice drop and they get cheaper, but I don't see why they would. I think he's just totally wrong. Let's see. All right, so that one's a bust. But anyway, point being, this is, by the way, that's a great example. You guys wonder what I do all day. That's what I do all day, though. I will be reading an article, and I will start doing, like, research. And I know sometimes I, like, forget what I'm doing. I forget to come back to the post, to the chat. But that's what I'm generally doing. I, like, read something and start doing research, and I'll start looking at things, and I'll be like, oh, what a waste of time. And then I'll go to then I'll look at more stuff in the same article. I'll be like, well, maybe there's something else there. So if we go back here, go away. This article is certainly not worth paying Barron's for. All right, large stocks with weaker earnings on quality, high short interest, weak earnings quality, high short interest relative to a peer group. Now, on the other hand, you could say these could be squeezed. Oh, come on, Dish Network. Viacom with a PE of 10. This is crazy. Sirius, is it? That can't be right. They don't have a PE of 800. Carvana, I kind of like Carvana. Restoration Hardware, I love Restoration Hardware, though I don't love it at this height. Expedia, we shorted. Wayfair, we shorted. All right, see, this is a more probably better criteria. Lyft, of course, is idiotic. Ring Central, I don't even know what their math is, but I'm sure it's stupid. Trex, I like Trex too. They're a good company, but not at that price. Yeah. The average short interest on this group is 11%. That's 5 times the short interest for an S&P 500 stock. And by the way, when you read things, those are good little facts to keep in your head, right? This is now you know something, right? Like 5%. I mean, 2% is normal for the S&P 500 for short interest in a stock. So when you see things over 11% with a short interest, you know that's a pretty large short interest. When you see 30, 40% short interest, that's extreme. But that goes the other way, though. That's so much short interest that it's probably going to blow up the shorts. Like happens on those Reddit trades. Because the premise of that guy for the Reddit thing is not that far off. Oh, how did I miss? I missed a line here. Boston Beer, Kellogg, that's mean. Baker Hughes, That's interesting. Biomarin. Nobody likes Biomarin. I'm intrigued by well, Restoration Hardware I could see has gone too far. Let's see. How do I stop doing that? Put it over here. Okay. RH. Oh, I love RH, but it just got so expensive we stopped playing it. But when it was cheap, I was loving that stock. There you go, look at that. There is nothing you can do better than cater to rich people. You know, when you can give something, you know, when you can sell very profitable items to rich people, you do well. And Restoration Hardware is just all, you know, all the fancy interior stuff, all the nice the nice fixtures and all that stuff that they sell, you know, everything that makes a rich home look rich. They're great. It's a great store. But again, very expensive, you know, ridiculously expensive, but nobody cares. The people who shop there don't care. And they really took off. Holy crap, this was an opportunity. Look at this. We missed that. So now they've just gotten stupidly expensive, $15 billion, and they don't even make $1 billion. So that's sad, right? They held up well. Look at 2020 though, didn't affect rich people. They still made $220 million. In fact, their earnings grew in 2020. They don't care. This is the honey badger stock. They don't care. They're like, what recession? We don't care. Rich people can still shop here. That's why these are so great. Then they're doubling. I'm sorry. Then they go from here. They're 2020 here. They're recovering this year. Next year they expect to double and then go back onto a path of normal growth. They're in fantastic shape. But who cares? They're still just, they're too expensive. Next time they go to 100, keep that in mind. But they're just way too expensive. And this is why the market is stupid too. Nobody looked at Restoration Hardware here and said, well, maybe they're not going to get hit that hard by a virus. Maybe it doesn't matter very much if people need to buy hardware fixtures and so on and so forth for home building. It's probably not going to stop or slow down completely and so on and so forth. What happened is you got rich people walking around the house. They get bored, and I'm sure this has happened to you guys, right? And your wife or whoever, or if you decide, and you start looking at that stupid bathroom, and now you're home all day, and you're like, oh, for God's sake, let's remodel that thing. Let's get it fixed up. You start doing things to the house because you're stuck at home all the time. So it kind of puts things in perspective. So I think it probably was not a bad thing at all for them in 2020. Obviously, it wasn't. It didn't hurt their top line or their bottom line at all. But nonetheless, these analysts who lump things together just basically took the stock down more than 50%. Went from $245 to $88 for no reason at all. No reason at all, which is why it is great to be a fundamental investor. There is nothing better than being a fundamental investor. It is the greatest job in the world because you get to pay attention to things like this, and all you have to do is say, hey, hey, let's go chase the antelope with a broken leg. That seems pretty obvious, right? It's going to be a lot less work for us. It obviously has a broken leg. We're going to catch it easily, and it's going to taste like every other antelope. That's how it works. But it's our job to look for the antelopes with the broken legs, not to chase after every random bullshit thing. Okay, when you're a lion, your job is to look for the antelope with a broken leg or whatever, or something slowing him down. Your job is not to, the lion next to you is saying, hey, how about that one? How about that one? How about that one? How about that one? And you're like, what's your premise? What is your premise, other lion? Why that one? Why that one? Why that one? Oh, he looks good. He looks good. I heard good things. This analyst told me that a lot of people were betting against that antelope. I want to go after it. That's your premise. How about how fast is that one compared to the other ones? How about that? How about, is that one easier to catch than the other ones? That's the one I want to go after. That's what this is. You gotta look at your stocks and pick the ones that are going to make you money. They're not all going to make you money. and they're not all without risk. And that's why, like I said, a lot of times I tend to do that, which I really should learn not to do that, but it didn't occur. I didn't think Cooper wouldn't have good options. That's why I didn't. But, you know, sometimes I look first, but you got to look first, because the problem is you can be doing all this research and looking at the stock and checking everything out. And then I suddenly realize, like, oh, the options suck, so there's no point. I'm not going to play that. And some of you guys who are new, I got to tell you, I mean, you might say, oh, well, what's that? Well, you know, what is that? Why don't you just play the stock without the option? Because once you get used to playing with the options, you realize that it's a complete waste of your capital. It's a complete waste of your buying power not to use the options. If you can't play the options, I don't care what the stock is like, unless it's like a penny stock where you've already got leverage. But, you know, I don't care enough about the stock to, like, you know, there's too many stocks I could play using options where I would take way less cash, make much more money in leverage, and so on and so forth on the same play. Oh, and that's what we talked about in the morning. I knew I wanted to talk about something else. That was important. So what we were talking about this morning, and again, I don't know, maybe I come across as boring sometimes. Same stocks I talk about all the time. Yodi hates it when I talk about WBA because he lost money on it. And look, why did he lose money on it? Because he had no faith when it went down. So he just rode it out. He didn't double down. He didn't go back into it or anything like that. Or I'm not sure, at some point he might have gone more in. But, you know, what we did is we chased it all the way down and we just kept at it. But in other words, WBA, we came in, I forget where, but probably around here, probably around 50 bucks almost, we came in. When it went down, though, to the 30s, we bought a lot more. And so we had a pretty hefty position here. Then we scaled back, and now we're just in it for the long haul again. But, you know, it hasn't been a phenomenal trade because we had a bunch when it went down, but it's a good trade, and I love them. And I still love them long term. And frankly, they're still worth way more than they are now. The fact that it's taking a long time to get there doesn't make them worth less. So I do keep mentioning WBA because WBA keeps being too cheap to not mention. Every time it's going to hit this 200-day moving average, I'm going to mention it because I love them down here. And again, I'm not a chart guy. It just so happens that this is where you get that fundamental cross. You know, there's a reason chart lines are what they are. And with WBA, the reason that you're seeing that on the chart is because that's around where their PE comes to 10. The 200-day moving average is roughly where their PE hits 10. See, they got $40 billion company making $4 billion. So that causes the PE to be there. And if you think about it, the PE, the earnings are consistently scaling higher. And last year for Walgreens, now Walgreens was actually closed last year. They closed. Their stores were closed. I mean, I guess you can still go to the pharmacy. Yeah, yes, because I went to the pharmacy. So you can still go to the pharmacy, but there was no basic store traffic. And unfortunately, Walgreens and especially Boots, who they merged with, they're more like you know how pharmacies are these days. They're like 75% like 7-Eleven, or convenience stores, or whatever the hell they seem to be. But but selling pharmaceuticals has become a side business for these guys. And so they need that foot traffic to make money. So, so Walgreens was going along nicely. They merged with Boots, which is a big British pharmaceutical chain. They bought a bunch of Rite Aid, but then they were forced to divest a lot of the Rite Aids that they bought. So they basically bought a bunch of Rite Aids, had to cut a lot of the stores and sell them off because the FCC was not happy about how big they got. And now they're kind of retooling. So here's where the M&A did actually hurt them, because the M&A had a lot of costs and a lot of acquisition costs. And then at the same time, they ran into, boom, the Corona time. And that's what made them dump under. But that, again, it's the same thing, except it's taking longer to play out. But it's the same thing I just said about Restoration Hardware. That was no reason to sell them. It was no reason to crash the stock. and they are bouncing right back and banging out $1 billion a quarter in profit, and you're only paying $40 billion for the whole freaking thing. Why would you not want to own that? So when it comes up, when it gets cheap, I'm going to make a play on it every single time. I keep making a play on it, and people are like, "Whoa, Walgreens, Walgreens again." I love it because you know that we're going to all need booster shots, right? And there's not going to be, the next time booster shots aren't going to be through these emergency government centers. Like most of us got our shots at some, cattle call place, like a DM, I mean, not at DMV, but it looked, kind of a DMV run kind of thing, where we went to some community center and there were like 40 people giving you shots, and everybody kind of, hundreds of people were like milling through every hour. It's not going to be like that for booster shots. They're going to be mostly distributed by your doctor or pharmacies. So huge amounts are going to go through pharmacies. Supermarkets too, probably your supermarkets that have pharmacies might do it. But Walgreens and CVS for sure are gearing up to do that. They expect this to be a big business in the future, that they're going to be giving people shots on a regular basis. We've always gotten flu shots. But flu shots are, I'd say probably, what was the numbers? Something, it was almost half the country gets a flu shot, like 160 million people get flu shots, something like that. But this is not, this is so the same people obviously who get a flu shot will get a COVID shot, because they're the kind of people who are predisposed to shots. And then you've got to figure that another half of the people who don't get flu shots are going to get COVID shots, because COVID can kill you. The flu just annoys you. The COVID can kill you. So annually, most likely, we are going to need COVID shots for the foreseeable future. And that's going to drive a huge amount of traffic into these stores, which just so happen to be perfectly positioned to capture that traffic. And while people are waiting, they're going to pick up shopping and do some items and so on and so forth, because they sell milk and they sell ice cream and they sell this and that. So they have everything at these stores. And for the kids, they got knickknacks and toys and candy and all kinds of stuff like that. It's a great place to be. I remember when I was in England, when I was a kid, when I go visit my grandparents, I used to love going to Boots. That was like that was a cool place because it was that kind of concept. It was a lot of stuff all in the store, and it was all like things that were, it was a lot of interesting things for kids. So it's always, they've always had that sort of thing, and Walgreens has moved to that model now. Anyway, also what I like about it is when I do the options, I'm like, okay, so the stock is at, it's another thing. So then I look at the options, I'm like, oh, I like these options. I can sell the $40 puts for $4. So here's the $40 puts. So I'm saying it's going to hold this $40 line where it consolidated a while ago. I think it's going to hold the $40 line. That's number one. I think that Walgreens making $1 billion a quarter can hold the line that it was holding when they made $400 million for the whole year. What do you think? You think that's a reasonable premise? So that's premise number one, is to say, okay, I think that'll work out. What the hell were you just looking at the chart? No? Oh, yeah, sorry, yeah. I knew there was a chart somewhere. So not only that, though, but the net, if I sell the puts, is 36, way down here. That's that's where it was bottoming out in this channel back when they were selling 1/5 as much, when they were making 1/5 as much profit. Now, so number two, so obviously these are basically no problem. I don't mind owning Walgreens at 40 when the stock's currently at 46. And so I take that $2,000, put it into the spread, and now we only spent $900 on $7,500 spread. So my worst case now is owning the shares at 40 plus 9, except that it's only 500 shares, so it's basically plus $1.80. So it's $41.80 becomes my buy price. That's where I'm going to get stuck with 500 shares of Walgreens. 500 shares of Walgreens is $20,000. That's a very small allocation, or well, hopefully it is, so you shouldn't be trading that many. But it's a small allocation in a $100,000 portfolio. It's $20,000. It's not nothing, but it's not going to kill you. And it should be using, if you have a $100,000 portfolio, you should have 200,000 in buying power. So you're using about 10% of your buying power. So you could at that point adjust it or double it down or roll it or whatever if you still want to be in it. So if for some reason it spikes back down to 30 again, you can double down and buy another 500 shares for 30. And these 500 shares cost you just under 42. So 30 plus 42 would be 72. And 4,000 share, 30 plus 42 is 72. Oh no, I didn't average it. Divided by 2, sorry, then divided by 2 is 36. So my average would be 36 on 1,000 shares, or $36,000. So now what I'm really committing to then is I'm saying, look, the worst case scenario here is it drops to 30 and I pick up the shares at 36, and now I've got 4,000 shares. And how much would I be down? $6,000. If my average is 36, got 1,000 shares, and the stock's at 30, and obviously I'm at 36, so I purposely bought it at 30, so I knew it was going to be down $6. But then what can I do? Then I can sell some more calls. Then I can sell more calls for $4. Some other calls for $4, and I can drop from 36 to 32 as an average, and the stock's at 30. So now what am I down? Now I'm only down a couple of $1,000, and I've got my short calls, and I can still make money. And this is why Warren Buffett's #1 investing premise is don't lose money. That's the most immediate. He always says the rule #1 of investing: don't lose money. Because if you can figure out how not to lose money on a trade, and if you never lose money on a trade, and sometimes you make money, you will do fantastically well. But you need to make sure you keep yourself in a defensive position that you're not going to lose money on a trade. That's why you don't want to expose yourself. That's why I don't like $400 stocks. It's harder not to lose money when you have a $400 stock. So that's where that trade comes from. And I said, even if you're in an IRA account and you've got $20,900 commitment here, you're still going to gain $6,000 against $20,000. That's a 30%, 30% in 18 months. That's, you're getting towards, it's close to 2% a month that you're going to make off this trade. Who doesn't want to make 2% a month? There are banks that promise you to make 1% a month, and people put hundreds of millions of dollars into these bonds to make 1% a month. And they're not even guaranteed. They're just like 1% a month. People are like, oh my God, 1% a month, I got to have that. And billionaires just drop hundreds of millions of dollars into these things. Well, here you go, 2% a month. And honestly, these bonds are ridiculous. It's not, they're not safer than this. So even if you have no margin, even if you have an IRA account, this is a worthwhile thing. But the way we're doing it, we're only using $900 worth of cash to make $6,600. And another one I love all the time, anytime it's cheap, I love them, and they're down 10% today. Woohoo! Great time to get them. SunPower. And again, SunPower, how obvious is this one to me? They have a high multiple. They're trading at like 50 times earnings, but those earnings are growing really fast, and it's a small company, and their entire sales is $1.5 billion. Well, that's next year. That's not even this year. This year they're $1 billion. So their entire sales is $1 billion this year. And so any money that comes in from infrastructure spending that goes towards solar, if they capture a tiny piece of it, it's going to boost them. It's going to blow these numbers out of the water. So these numbers are probably wrong. They're not taking into account. Now, this infrastructure bill that we were talking about today in the main post has not actually passed. It's only going through the Senate, and the premise of this bill is that the Senate is going to pass it, which is iffy because the Democrats only have a tie in the Senate. So they want to put forward the spending package in the Senate and ratify it in the House, where they do have the majority. And if they can pull that off, and they're doing it by cheating, they're using the rules of whatever rule it is. They're not calling it a spending bill; they're calling it an appropriation bill. Something bullshitty like that. And the Republicans are freaking out, but that's the only way you're going to get anything passed is just ignore them. But they have to have 100% Democrat. Not one Democrat can dissent on this bill. So that means that they are negotiating the crap out of it. But now they seem to have an agreement, though. That's the thing. They're negotiating the crap out of this. It started out being $6 trillion that Biden wanted earlier in the year. There was no frickin' way the Republicans were going to allow that under any circumstances. They formed this commission, they put it through, and they cut it down to $3.5 trillion, still quite a bit of money. And then we already passed 2.1, so it's 5.6 trillion at this point, down from 600 billion. And there's another 1.2 trillion. Hard to get used to the fact that it's 1,000 times more than a billion. 1.2 trillion additional spending is going to be appropriated specifically for climate change and clean fuels and clean energy and things like that. So it's bigger than it looks, but that's they're trying to break it down into bite-sized chunks that they can slip past the Republicans. So. And these are things that are going, and now, I'm sorry. So in other words, to get all the Democrats on board, some of them will be standing fast and saying, I will not sign a bill unless we're addressing my key issue. And Bernie's key issue, and you have to make Bernie Sanders happy, he's very powerful. Bernie's key issue is, of course, health care. Other senators demanded improvements in Obamacare that they said you cannot neglect it. And not that you have to push Biden very hard for this, because Obamacare is done with him also. But you have to, they want to see Obamacare funded properly and strengthened so that it can't be broken by the next president, by the next Republican president. And they're also talking about more integration of. They're like saying, what's the point of promoting jobs if you don't promote daycare? Because then what you're doing is you're only promoting jobs for people who can afford to leave their children in daycare. Promoting a job and giving you say, oh, you have a great job, you can go do this and that for 40 hours a week. But if the people don't have access to daycare, because even a great job, if you're starting out at entry level and a great job and it's got a good career path, doesn't help you if you already have kids at home and you're trying to take care of them. Someone has to deal with them after school and so on and so forth. You don't have that ability, and you don't live in a safe enough neighborhood where you feel comfortable with your kids being home by themselves when they're young. This is stuff that a lot of us don't think about. What happens to working class people? And then we sit there and we go, oh, look at the gangs and look at the violence. Look at Chicago, this and that. And meanwhile, again, believe me, Mr. Bleeding Heart Liberal, but I'm sorry, but it's people complain about this stuff, but then they create systems where you're throwing children to the wolves. What do you think's going to happen if kids come home to an empty apartment in the middle of downtown Chicago? But there's nothing for them to do. There's no park, there's no basketball courts, there's no gyms, there's no programs, there's no after school, there's nothing, there's no supervised athletics. That stuff matters. We take it for granted when we're suburbanites. Or we live in nice city places where they have the kids do things at their school because they're charter schools or whatever they are. We don't think about the struggles of people who are in the bottom 50%. And giving them a better job isn't the whole solution, because even if you go from McDonald's where you're making $20,000, or I hope. So even if you go from McDonald's where you're making $20,000 to a job at a call center or something like that, and you're making $35,000, after tax, you're only probably about $10,000 better off at best, maybe probably $7,000 better off. And if you have to spend that money on childcare, there's no point. So you have to have a balance. There has to be more to it than that. Oh, there was a great article today, 2 great articles. I liked them. in the news. One was like, and again, this is the kind of stuff you got to read and you got to think about it. I hope it came up. McDonald's, there you go, McDonald's. Oh, where's the Burger King one? Oh yeah, right here. McDonald's franchises offering childcare and tuition to attract employees. Why? Because Burger King staff left a note on the store sign saying, "We quit." McDonald's isn't doing this because they're lovely people. No, don't go away. Jesus. Oh, this advertising should be illegal. Look at this. We all quit. Sorry for the inconvenience. That's so great. So anyway, so McDonald's isn't doing this out of the goodness of their heart. That's the market now. These people have power. The workers are getting power. And so McDonald's is reacting, and the franchisees are getting together and trying to use their accumulated buying power to create McDonald's type, McDonald's daycare system and ways for people to be able to come to work. They got to be able to say, here's how you can come to work and make money and be rational and sane. There's a lot of single mothers at home who would be perfect McDonald's workers. They're nice people who are well spoken and educated and above the level of the kind of people who just come off the streets from McDonald's, but they have a problem. Their problem is they're raising children. They'd love to make $20,000, but the math doesn't work if $20,000 causes you to put your kids in a daycare that costs per kid, let's say $200 a week. I think that's the right price. Yeah, it's probably. I don't know what I seem to be the right price for daycare. It's a lot of money though. That's the bottom line. It's like basically. So if you go to earn $500 a week at McDonald's, if you're lucky, and you spend $800 and you spend $200 a week to take care of your kid, it's hard to really justify what you're doing there. So you have to help the people, and this is going to be all the workplaces. In fact, look, this is why we first had healthcare in the first place, because people were freaking out about the cost of healthcare. In the 70s, healthcare costs were rising and out of control, and people and more the workplace had to offer you healthcare in order to get workers, because it was the same situation. There was inflation, the costs were increasing, and people couldn't afford to work, and the employers had to make concessions. But what does all that mean? All that means not just, oh, that's interesting, but oh, okay, so there we have a whole nother cost, which is very significant, which is going to be a good 10% of salaries, maybe 20% of salaries added now to McDonald's bottom line, to cost for McDonald's bottom line. Now, that it's the franchisees, the company isn't offering it, so it's being borne by the franchisees, but they're going to in turn probably raise prices. McDonald's tends to have pretty strict pricing policies. So we'll see how that plays out, but it's an inflationary thing. It's a thing that once you give it to people, it's very hard to take it away. Because if you have 1/3 of your staff is taking advantage of your daycare system, and then you suddenly decide to discontinue your daycare, you can lose 1/3 of your staff very quickly, and that's very disruptive. So, once they start doing things like this, it's hard to stop. But it's an interesting trend, and it shows you that the restaurant industry is certainly going to be incurring more and more costs, which brings us to CMG, who we're shorting, because they're going to be under the same kind of pressure. And so we are short CMG. Has not been working recently. I was just talking about that the other day. But they are at a ridiculous, came down a bit. Not much. So I was talking about CMG, they were over 1,600, they're coming back to 16. I mean, this is insane. It really is. And we shorted, I think we have 1,500 short calls or something like that. So we're just waiting for it to calm back down. But this is just a ridiculous price for Chipotle. I mean, if you look at them, I mean, this is one way to scratch your head. $45 billion in market cap, and they don't even make $1 billion. In fact, you know, the estimates here are pretty high, so we'll have to see what the earnings are. I said these earnings, I can't see these earnings. Why are they going to be at an all-time high earnings and all-time high revenues all of a sudden? I think they're extrapolating a lot of stuff that's not likely to happen. That's what I believe. Also, though, very nice hold up during the pandemic. Didn't really have a didn't take a hit at all, frankly. I mean, didn't take any hit at all on the earnings. Didn't take a hit on the revenue. Everything was hunky dory for them. I don't know what they did that they expect to get 1.3 billion, which is 20% more revenues this year. I don't know why their profits are going to double. I think labor costs are rising. I think food costs are rising. I don't think they raised the price on their menu that much. I think these numbers are wrong. I don't think they're going to hit these numbers, but we'll see. But I'm waiting for the earnings. But I just don't think this is too much, too soon for them. 50 times earnings for a fast food franchise is a little bit silly. Do they have competition? Do we have competition anywhere in here? Compare with? No, that's not really it. La la la. I don't see. Oh, here you go. That's good. Similar. So Domino's, Darden. It's hard to say who do you really compare them to. I guess you compare them to like Wendy's, or you compare them to McDonald's. Yum Brands is kind of low key. You know, McDonald's. I mean, look, McDonald's is not that great either. But if you just had to compare it to something, I guess by size and so on and so forth, I'd look at. Well, McDonald's is much bigger. Okay, so these guys 45 billion. McDonald's is 176 billion. All right, but McDonald's, their PE is 25. It's half of what Chipotle is. And Wendy's, they're much smaller, 5 billion, but their PE is 28. That's normal for it's actually not, it's not normal. 15 is normal, but these days 28 is normal apparently. What do we say, Darden? DRI? There you go. So they're 19 billion. All right, and they're running at a 20 PE. I like DRI, they're good actually. Cake is my favorite in the restaurant space. I do like them a lot. All right, then they're not making money. All right, but I like them because they have a $3 billion market cap, and when they do start making money, it's going to be significant improvements in this company. So right now, you know, they unfortunately they took a huge hit. They expect to get back on track. We'll see how they go. But if they start showing real improvement, I'm going to be very interested in playing these guys for the long haul because this has been a rough road for them. And I think they're going to come out of it and be very strong because it's a very solid operation. But interesting over there. And so, you know, technically their PE is 20 at the moment because they're expecting $111 million in sales. But in any case, you can see how out of whack Chipotle is. Nobody should be priced at that level in this space. It makes no sense. And we will see how that plays out. But I really think that they're due for a big crash. The other one that we shorted is a Wayfair. This is a freaking furniture store, for God's sakes. Oh, they came down nicely. Our target is 250, and they're actually now they're hitting it. They're at 281. So they're already coming back. I was talking the other day about how stupid this valuation was. Now they're kind of flying down. But again, this is a furniture store trading at 50 times earnings. This is what happens when you're trading at 50 times earnings, when there's no reason for it. You can crash really fast and really hard. Because your valuation, your real valuation is going to be in the 25, 30 range if everybody loves you. But these guys just are not going to make, you know, it's such a hard road to sell that much more furniture and make $1 billion and so on and so forth. It's a crazy premise that they have for these guys. But anyway, so back to that. So it's our jobs to read the news, and or like I said though, I'll read the news for you. I'll check these things out, but I thought it's a lot more useful to be able to show you, like, this is what I'm reading, and this is why suddenly I talk about something, because you say, you know, usually I come up with a trade and be out of the blue. But you know, I try to say, this is why. I read this infrastructure package, and I said, well, let's see, given this infrastructure spending, who's going to benefit? Well, Walgreens is going to benefit because there's infinite money for vaccines. They're expanding Medicaid. This is the key things you want to see. They're expanding Medicaid, and that's going for, what did it say? There's not that many words here. Why can't I find it? Here it is. Expansion of Medicare to provide money for dental, vision, and hearing benefits. That's a lot of stuff. So if you now provide for things like that, now don't forget, you got to think about the dynamics of this. You go to the dentist, and the dentist tells you, get this, get that, get this, right? So they're telling people to go to Walgreens and get stuff. When you go to the doctor, what do? They send you to Walgreens. When you go to, not eye exam, vision, well, vision depends on the kind of vision, but if you go to an eye doctor, and this is all suddenly covered, this is things people are sitting at home not doing because it's not covered. But if you suddenly send millions of people to now get eye exams, a lot of those people are going to be told to go to Walgreens and pick up some drops. And by the way, when you pick up the drops, it's not one time, it's you pick up drops, and for the rest of your life, you get in the habit of taking these drops. You guys know this, you know, people's medicine cabinet, you know, you go to see your grandma's medicine cabinet, you're like, holy crap. It's like, really? Every little thing you have to start fixing. And hearing also, hearing aids, hearing aid batteries, things like that. Where do you go for these things? You go to Walgreens, you go to the pharmacies. So it's not just going to the doctor, it's going to the doctor, and then what happens to you once you go to the doctor? The doctor says, take this, take that. Some things they prescribe, some things they don't. It doesn't matter though, the point is somebody's gonna come in. Now, another thing people are underpricing, and the reason Walgreens is down right now, people think that Bernie Sanders on his high horse saying that we're gonna pay for expanding Medicare by having Medicare negotiate with the drug companies to get better pricing. That is an absolutely correct thing to do. We are being ripped off massively by drug pricing, and Michael Moore did a whole documentary on that, so I forgot what it was called, but it was Sicko. Michael Moore did a whole documentary on that. We are being totally screwed in pharmaceutical, in payments. We spend a ridiculous thing. I think we spend $2.5 trillion a year on medicine in this country. It is more than 10% of our GDP. It is 12, 13, 14% of our GDP is spent on healthcare, which is double any other country in the world, double any other country, triple the average for the world. We spend on healthcare, and our outcomes are not better. They love to tell you the propaganda is it's the best healthcare system in the world. It is not the best healthcare system in the world. It is a average healthcare system for a developed country. It is absolutely not the best in the world. And the reason people fly from other countries to the US is because there are plenty of other countries that suck. There are plenty of top world-class specialists in the US who would never get paid what they get paid here in another country. So the best doctors from many, many countries come to the US to practice. Doesn't make our healthcare system better, just makes it more expensive, because the best doctor in France would be making $1 million or $2 million a year operating on people in France. So he says, screw that. He goes to America where he makes $5 million a year and gets paid more. Doesn't give you a better outcome. He just moved from France to here. It doesn't give you better care. It doesn't make your doctor any better. But if you happen to get, you know, whatever little heart thing he knows how to fix, if you happen to get that outcome, that's good for you, but it doesn't move the needle enough to give the US better outcomes, but it does make the US much more expensive because everyone comes here to get rich because we let them. Other countries don't put up with this bullshit, we do. So anyway, the bottom line is there's so much fat. You could literally take half the money we spend on healthcare, $1.25 trillion per year, which is more than all the funding for Medicare total. More than all the money we spend on Medicare is the money we waste on the current healthcare system. So Bernie Sanders is 100% right when he says that we could trim the cost. The expansion of Medicare, and what he's doing is $400 billion a year. That's his expansion of Medicare. He's talking about 55 and over, you go on Medicare. Medicare is top to bottom coverage, and you get the things he added there, the vision, healthcare, the vision, the dental, the hearing is all covered. So in other words, once you hit a certain age, you don't have to worry about your health anymore. That's what it's about. You're out of the private system. And how do you pay? And you go, oh my God, how much is that? That's $400 billion a year. How the hell are you going to pay for $400 billion a year? You're going to take that money away from the excess fees that are being charged by the pharmaceutical industry, by the healthcare industry in total. You start cracking down on all the money because the government is paying them anyway. You're going to start cracking down on all this money the government provides to these people, and the private enterprise can start cracking down too. So it is doable, it is budgetable. The OMB went over it. It all flows through. It all makes sense. And this guy, Bernie Sanders, again, I'm sorry, I'm a liberal. I like these people. I don't have this visceral hatred for him because I said Bernie Sanders. This guy has been on this his whole life. He's been working this thing for 30, 40 years. And you cannot stump him on this, and you cannot get around him, and you cannot bullshit him. He knows the facts. He understands it. It's like Elizabeth Warren with financial. You cannot sit there with Elizabeth Warren and start spouting off some crap and confuse people, because she will nail you to the wall. And those are the kind of people you do want in government. You want people who are complete wonks on policy and understand the ins and outs of what they're talking about. And they're basically both, they're saying this thing has to be changed. And it does. We know that. I mean, it's just, I can't imagine people don't know that this is a bad system and that we have to change it. We can't keep going like this. But anyway, so there you go. So there becomes your premise. So what is Joe Biden doing? What are the Democrats doing? Whether this thing passes or not, this is the direction they're pushing. More money will go to healthcare. More money will go to renewable energy. That will happen. And so those are the places I want to be putting my investment money into, the things that the Democrats are funding. And I like this. This is really nice. So Biden's 2022 non-defense discretionary budget. Where's the money going? Education, commerce, health and human services. See, these are the biggest increases. So in other words, this line here, there is a 35% increase in the education budget. There is a 45% increase in health and human services. There is a 25% increase in housing and urban development. There is a 25% increase in state. Well, state doesn't help us. We can invest in that. There's a huge investment in the VA. That also is not really investable. Energy, alt energy, 46. So it's up 20 something. It's up 20%. It's at $46.1 billion. So that's the money they're pouring into alt energy. Like I said, SunPower only has $1 billion in revenue. $1.5 billion next year is projected. So 46 billion is being put in. That's 20% more than last year. So it's about $9 billion more than last year is being thrown into the energy space. If SunPower just gets a little bit of that money, 10% of that money, that'll double their revenues. 10% of the additional allocation of energy goes to SunPower, and they double the size of their company. That's the kind of thing that you want to invest in, right? That's a trend that you can see coming from a mile away. Poor NASA, not getting any love. You know, but who's getting the bucks and who's getting the big increases? The EPA got a big increase, but now you look at the EPA getting a big increase here. Oh, that's not going to be good for the people who pollute, right? But it's not, you know, it's still a terrible little budget for the EPA. It's just $11 billion, but that's just the way we do things these days. But that's what you look at. This is basically telling you where the money's going next year. I mean, how much more could they do to tell you where to invest? But again, goes to bias, right? It goes to bias because I don't mind reading this. I'll read these articles because I'm a liberal, because I read the New York Times. I pay attention to these things, and I don't just go, oh, those bastards, blah 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 blah. I'm like reading it for this reason. But I'm also telling you, I see all this stuff as good and okay. I think this is a great use of money. I think this is what we should be doing. Other people are going to disagree. And does it cloud my investing premise? Of course it does. So when I tell you that I like Boots and I like SunPower, it's because of this stuff. It's because I also like the Biden budget. I also think it's going to go a certain way. So is my analysis clouded by my political thought? Yeah, of course it is. And should you know that about me? Of course you should. Should you know that about every writer? Yeah, of course you should. Do you? No, because most writers will never tell you. Most analysts will never tell you anything about themselves, what they're thinking, and so on and so forth. And it's not a benefit. It's not a feature. It's a detrimental thing. You shouldn't be buying from a black box. You shouldn't be, you know, listening to people who don't tell you what they believe, what they really are about. I think it's important that you know what I'm reading, you know what I'm thinking, you know what I'm talking about, and then you can make your own decision. I think global warming is real. I think climate change is a huge thing. I think every year there's going to be more and more pressure until it finally becomes accepted by people that this is a true thing that's happening. You know, it's funny because people who lived in Pompeii in the year one, you know, I think it was like I think the year 79 or something like that it erupted. Is people living in Pompeii in the year 1 and 2 and 10 and 20 and 30, the mountain would rumble once in a while and whatever, blah 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 blah. But then sometime around the year 50, 60, 70, people noticed that the mountain would rumble more and more and bigger rumblings, and they knew that there was something going on in the mountain. They knew this, yet nobody moved. I mean, some people did, I'm sure, but it's the same thing. People do this all the time. It's like you're living in a city that's right next to a mountain that could blow up. And they knew what a volcano was. They weren't surprised. They thought it was a dormant volcano. But if it's a dormant volcano, why is it rumbling all the time? Why does it keep shaking the ground? But Pompeii was, you know, the Paris of Greece, basically, and those people, not Greece, sorry, Italy. So Pompeii was like the Paris of Italy, and it was an incredible city. It was wealthy. It had arts and trading and blah blah blah, and everybody loved it. It was a fantastic place to live. It's gorgeous. I was there. Oh, what a great place to visit too. Anyway, so. But the mountain's right freaking there. And meanwhile, you know, okay, so good, we go visit it. If it was rumbling, I wouldn't go visit it. Yet people keep living there, people keep building mansions, blah, blah, blah. And eventually one day the thing blew up and everyone's like, oh, who could have seen that coming? Like, yeah, it's easy to see things coming like that. It's incredible, though, how much people deny what's right in front of them. You know, there's a lot of studies that are telling us that Miami will be underwater, almost, basically uninhabitable in 2050. That's 30 years from now. That the water levels in Miami will make it pretty much, most of the city is gonna be uninhabitable. Yet people are still buying homes and apartments on the water and blah blah blah. Because you're gonna have this massive problem in 2050. Doesn't mean that in 2020. That doesn't mean in 2049 nothing's going to be wrong. It's going to get worse and worse and worse every year. And it's not something that happens really fast. It's that incrementally it's going to happen. Oh, here. Florida global warming. Animated GIF. I think you guys can see this. Let's see. Yeah, you see this? I hope you can see that. Let's see if we can make it bigger. Look at it. Where's Miami? There's Miami. There's me. You know, it's not like, you know, it's not like you can stay until the last minute and leave, because first of all, no one's going to buy your freaking house. At some point, people are going to realize these things are getting wiped out. Key West is going to go first. Where's Key West? Key West is there. There's Key West. Key West is going to go first. I'm going there this weekend, in fact. You know, get there while you can. So there's a land bridge here that's just barely above the water that you drive down. So you go down past Miami and you go down to Key West like that on the water. All this stuff, though, these seas that feed into Naples and the Everglades and all that, it's going to get chewed up, and you're almost getting up to Orlando by the time it stops. And that's what's going to happen in Florida. So, you know, those of you who don't like Florida, it's going to be gone. Now, not all gone, but just part, you know, it's going to be like that. Now, who knows what's going to, you know, who knows what'll end up, but this is happening. It's not happening. This is what is happening. It's just going to take a long time for it to actually go through this cycle. And that depends on what we do to prevent it. But look at the Bahamas, it's Cuba. It's like a disaster. I mean, it's terrible. Look at Cuba. Cuba's going to be gone, basically. Meanwhile, we have riots here. We have riots here. So none of these are not far away from me. So, you know, some people just don't believe this stuff is real. But you can look at the maps for the last 20 years and you can see that is happening. You can see it starting to erode. And it's getting faster and faster and faster. It's very scary stuff. So anyway, what else do we look at? We're starting to review our portfolios, of course. I'll finish them up tomorrow, hopefully. And we talked about the dividend portfolio yesterday. You know, but it's do we have some power? We don't have some power in here. Let's see, where do we have some power? Got to be in the futures now. So, you know, we have some power position here. So we already took these positions, but if you look at this one's not even very much ahead because we did it in May. This is a 2035 bull call spread on some power with $20 puts. So we're pretty conservative on this one. And we have 50 of those. We paid, well, we're barely up. We're only up about, look, we're plus 46 plus 12 is 58, minus 4. We're up about $1,800 on this. But it's a $75,000 spread. We paid 40 minus 20 minus 10, so we paid about $13,000 for it. And like I said, we're up 1,800. So what I said, we paid 13,000, 13 with 13. So now it's 15,000. Still a $75,000 spread. So that's how we jumped into SunPower here on this portfolio on the futures now. And again, we've been talking about SunPower for a long time, the stock of the future that we want to move forward on. But that's it. I mean, that's what fundamental investing is. It's reading and paying attention to what's going on in the world, not just the stock. And this is a mistake. This is why most analysts suck. They look at their sector, they read about their sector, they don't worry about other stuff, they don't think about what else is going on in the world, they don't think about how other things affect them. You can't do that. You know, when we made a ton of money in the short-term portfolio because back in January and February of last year, I was going on about the virus, and people are like, you shut up about the virus already. What the hell? How about we talk about the stock market? I'm like, the virus is the stock market. That's fundamentals. A virus in China does matter. You know, the debt crisis matters. This is my other bug now, is the debt crisis that everybody's ignoring. The debt crisis matters also. We are so massively in debt as a planet. It's going to come back and bite us in the ass. You are not going to escape this. You're not going to be able to ignore it. It's a little easier for people like us who have our own central banks that can just print money, but that leads to what? Inflation. But inflation is not necessarily bad for investors. We get to benefit from inflation because we just invest in companies, the stock prices inflate, and we keep up with the inflation with our investments. So we're able to afford it, while people who don't have stocks and have jobs where the salaries don't keep up with inflation, they just end up going bankrupt. And the people who rent get kicked out of their properties, can't afford anything. They lose all their money, so on and so forth. So, and again, Mr. Liberal talking about it. If you hear this from a conservative, they'll tell you a whole better story. But the reality is, sure, we can play along at home. We can ride the inflation wave, and we can do very well in an inflationary environment. But that means we have to be invested, which is why I would rather keep having a long-term portfolio that's hedged than just go straight to cash, because we don't want to miss out on a crazy inflationary market, which is certainly what we're getting. Look, everything's up, everything's up, and pretty much doesn't stop going up, except the Russell, which is now in a pretty nasty downtrend. Look at that. But this makes you think too, right? The Russell is back to where it was 3 months ago. Lost all its gains from 3 months. NASDAQ is miles ahead of where it was 3 months ago. The S&P is miles ahead of where it was. So Dow's up 1,000 something points, 1,500 points from 3 months ago. What if the Russell is right? And let me tell you something, if this line doesn't hold, if 2,200 doesn't hold, everything's going to start to get dragged down. Because these guys have a lot of catching up to do to catch up to the Russell. But they will end up catching up. It's like you know, one doesn't stray that far from the others before it starts exerting a bit of a pull. So we have to be very careful about this stuff. It's a tricky time in the market. You don't want to miss out the next leg up, the next thing up. And if we were looking at Apple today, you know, it's like, when would you pull the plug when it does this? You know, it's like you feel terrible not being in it, right? Because 150, like 150, isn't that like, I don't even know what the number is. Where's Yahoo? No, I use this. So 150, $2.5 trillion. That's where we're at. $2.5 trillion. The PE of Apple is now 27. Now, here's the thing. Apple used to have a PE of about 15. It was perpetually undervalued, because 20 would have been fair. But Apple used to have a PE of 15. So the PE has doubled while the company has blown up and is now making $86 billion a year. So if it's making $86 billion a year, it's not that crazy to pay $2.4 trillion for it, but it's still 30 times earnings almost. So, but the problem is, when you're talking about numbers this big, it's like, where is this money coming from? Where the hell did look, here's 100. This isn't, look at 3 years. Here's 50. In fact, we were 50 last March, but that don't count that. Let's say 50 was really back here. So 2 years ago, 50. Now it's 150 in 2 years, so we tripled. So it's up 200% in 2 years. It went from 800 billion to 2.4 trillion dollars, 1.7 trillion dollars, 1.6 trillion dollars. was added to the price of Apple. It's a lot of money. It's a significant portion of the world's GDP has been added to the price of Apple stock. The addition of the price of Apple stock causes the world's GDP to look higher. It grew. It's part of the world's GDP. So Apple accounts for, let's say the world's GDP is $100 trillion. So Apple accounts for 1% of the world's GDP growth. The world's GDP growth is only about 4 or 5%. And actually last year it wasn't probably zero. It might have been negative last year. So Apple, if let's see, I mean, these are half years, so it's tricky, but let's see, world GDP growth. Oh, there you go. That's lovely. At 2020. So last year it was negative, -3. Even if it's 6 this year, you're still going to average 3%. That means Apple is essentially all of the world's GDP growth. That's about half. So Apple is basically half of the world's GDP growth over the past 2 years. But that's a tricky thing because Apple also contributes to the world's GDP growth. So it may in fact be all of it because, you know, the GDP growth of the world wouldn't look like it looks if it wasn't for Apple growing $1.7 trillion. And it's not just Apple, it's Apple, Tesla, Microsoft, blah, blah, blah. So all of the growth that we have, all of the GDP we count, all the measurements we make are being made on a ridiculous premise that these stocks are actually worth now double, triple what they were a couple of years ago, even though their sales haven't changed much. And Apple happens to be kind of an exception because they really are selling more. But not everybody. That's not going to be true if you look at other companies. So Apple sales actually went from 260. So it went from 260 to 360, which is up 100, which is, you know, pretty good growth, but 40%, not 200%. And then if we look at Microsoft, Microsoft has only gone up from 50 to 56, 10% growth. Yet Microsoft is another one that has an insane, oh, that's Morgan Stanley, shit. I'm like, wait a minute. So I like want to throw the cap. So Microsoft, $2.2 trillion. They went from 110 to 160, so they're up about 50%, but also their actual stock price from here is up 200%, same as Apple, and also trading 33 times earnings. It's not realistic. It's not sustainable because the only reason this is even possible is because all the countries in the world are throwing money into the economy, giving you the illusion that this growth is going to keep going. But unless they keep spending this kind of money, it can't keep going. That's why I am cautious about these things. All right, so we're gonna wrap it up, but yes, because I'm out of tea, so we're definitely gonna wrap it up. I can no longer drink, therefore we are wrapping it up. But the point is, these are incredible numbers. This isn't small potato stuff. And how are you going to sustain that if they stop throwing money into the economy? Where is it going to come from? It isn't going to come from these revenues. Can't. They're not there. They're not big enough. All you're doing is paying more money per dollar of revenue. And that's not sustainable. So something is going to snap at some point. We don't know when. Just like 1999, you don't know when. It could go up another 100% and then snap. There's no limit to stupidity in the markets or anywhere for that matter. But you know, you can't say it's definitely going to stop here, definitely going to turn here. But the bottom line is this can't keep going. You can't have enough. What's going to happen? Is Microsoft going to add another $1 trillion over the next year Are they going to keep growing at 50% per year? Is Apple going to add another $1 trillion? Where is that $2 trillion going to come from? And it's not. And then you've got other companies. You got Facebook and Oracle and so on and so forth. You got a lot of other companies that are up in the high ranges. And where is their money going to come from? Where is all this money coming from? It doesn't. It's a fantasy. It's based on this multiple of 30 times earnings. It used to be 15 times earnings. You're just paying more money for the same thing. And that means that money is being taken away from other places where it maybe needs to be. But the way the stimulus works is it's providing a tremendous amount of free capital or low interest rate capital to the top 1%, who are the principal holders of all the equities. And they're getting richer and richer and richer. And because the government is flooding money into everything, and again, you have to just keep in mind what this is. I mean, when last stimulus was $2 trillion, we have a $20 trillion GDP. So each quarter, our GDP is $5 trillion. The government put $2 trillion into the economy in a $5 trillion quarter. Now they want to put more money. Now it's 3.5 trillion, I think, is over 10 years. So it's really going to be, it's only 600 billion a year, or whatever the hell it works out to in the end. There's only going to be like 600 billion a year. It's not a huge extra amount, but they are going to look to front load stimulus and so on and so forth into this package because they still need it. So let's say in the first half, the government puts in $2 trillion. So now it's 2 trillion out of 10 trillion in GDP for the first half. That's still 20% of our GDP. And yet they crow about the fact that we're putting up a number of 6% GDP growth. 6% GDP growth with 20% stimulus is minus 14%. If you really had 6% GDP growth, it'd be 26% because you added 20% too. But you added 20% and your cup only filled up 6%. That means there's a hole. It means there's a 14% hole in your cup. So your cup does not runneth over in this case. It's still leaking terribly. And it's craziness. So that's why, honestly, I mean, that's why we're not picking a lot of top trades. We're being very careful about where we're going. We go back to the same value stocks a few times because that's what's safe to trade. I don't want to trade what's unsafe, not in this environment. I know that the market does nothing but go up. I'm well aware that this never seems to end under any circumstances, but that's what you always think in the markets. This is just the craziest thing since the crash back here when the Fed started pouring money into the economy. They have never stopped, and they are adding and adding and just artificially inflating the economy. And maybe the new money, the modern monetary policy people are right, and that debt doesn't matter, and it never will matter, and that the governments can just keep printing money, and if they print money, it's money and you can spend it. End of story. No consequences. If they're wrong, it could be the biggest disaster in human history. So, you just got to play for the just in case also. just in case they're wrong. All right, well, on that happy note, thanks everybody for coming. I hope we learned something today. We learned Crown is a good value, but you can't trade it. Not Crown, Cooper. And we'll just get back on this thing next week. Oh, next week, let me see. Yeah, I'll be back. I'm going to Key West this weekend. I'll be back for next week, no problem. Then the week after that, I'll be in Orlando. Probably won't do a webinar from Orlando because I'll be there for the whole week at the end of the month. But I will still log in for the chats and so on and so forth. All right. Have a good day, everybody. So we will see you again next week. Thanks.